There's some crisis in the news every day, usually multiple crises at this point. And I know it seems like they're coming at a faster and faster pace and that the world has gone crazy. I see it too, and I'm not going to tell you that you're imagining it. However, and this is something that I've been saying to clients for many years now, there have always been negative news events. People romanticize the past as more simple. You know, we hear all the time now, for example, how Democrats and Republicans used to get along in Washington, and that was true about 20, 25 years ago, maybe even more. Washington immaturity aside, major events around the world can and do have an influence on stock prices. But it's notoriously difficult to predict when these events will occur or how they will impact markets. What we observe from previous crises is that stock markets eventually rebound, and sometimes very quickly. A great example is the Brexit decline in 2016. Remember that? Funny how big events fade into a distant memory, isn't it? Here's a headline from USA Today. So here's a chart of when stocks fell that year, 2016, and then they came back pretty fast. That's really common. You can never be sure how a single event will impact stock prices. Many factors influence the market. Although major events and stock market movements may be related, believe it or not, it can actually be challenging to determine correlations. Also, after either good or bad news, stock prices may not move in the direction that investors expect. It's not enough to identify major events in advance. You also have to accurately predict how markets will react, and that's insanely difficult, right? If it were that easy to just predict how markets would react to a specific event and know this ahead of time, then you, me, the biggest hedge fund managers, the middle school kid down the street, we'd all just trade the news and rack up gains. Easy peasy. But we all know it doesn't work that way. Reacting to a crisis by stampeding into cash or looking for a trade that is a sure bet given the news is usually just a futile exercise, and it only amounts to market timing. There's plenty of research and market-tested data to show that markets incorporate all available information. This goes back 60 years, this research. So once the information related to the event is already known by investors, the prices have already adjusted. You can't get ahead of it. Okay? The algorithms and professional investors are faster than you are when it comes to that. In addition, if you flee the market after a major crisis, then you have to decide when to return to stocks. I've heard it more times than I could tell you. I'll get back in when it's safe. But markets are never safe. That's a ridiculous premise. It's exactly the market risk that results in a return. No risk, no return. That's why you invest. In many cases, the decision to reinvest comes after the rebound has already begun, so you missed an opportunity. Moving in and out of the market can also incur additional costs, have potential tax implications. Who wants tax implications, right? So investors are better prepared to apply discipline during a crisis if they have realistic expectations, take a long-term view, and understand why some investments have higher expected returns. That means stocks return more than bonds, and some types of stocks have higher returns than others. Stock prices fluctuate through time, and there will be periods when prices fall. However, a major event in one market, like the US, may not affect stock prices in all markets, such as European or Asian markets, and that's one reason to hold a globally diversified portfolio. Also, other asset classes, looking at you bonds, can help minimize the overall volatility on a total portfolio. It's really important to have an understandable strategy, okay? Not just something an advisor puts into place and you have no idea what they did. Make them explain it so you can understand. Don't feel dumb. Make them explain. They're not smarter than you. Market declines can help you look past daily news, focus ahead on the long term. That's what an understandable strategy will do. A portfolio with ups and downs, that's just life. But over longer periods, the odds of realizing a positive return increase. For example, over the past 40 years, nearly half of the daily returns in the S&P 500 were negative, while only 1/5 of annual returns were negative. Got that? It means the day-to-day noise may not have as big an effect as you think. So checking your portfolio's value often in response to bad news may increase your exposure to short-term pain. Just don't do it. All right, if you want any help with evaluating your portfolio, how to get an understandable strategy that works for you and will help to keep you disciplined in some of these market conditions, check us out at bluemarlinadvisor.com. Reach out. We're happy to help you.